This is banks. While some of the liquidity programs are sometimes a bit under the radar, very central bank, in some sense, what was done with capital and guarantees, nothing was done under the radar. This is, in some sense, one of the most successful programs. The liquidity programs were extremely successful, but these were incredibly unpopular. So we get to hear a little bit more about that. I think we'll start, Dan Jester will start, and then Lee Sachs will follow, and then we'll do some questions.
Okay, good morning. The capital purchase program was the first use of the $700 billion authority that we obtained from Congress. By early October 2008, as many of you recall, the financial system was unraveling. As just one marker of the fear that was present at the time, in the week prior to our announcement of the capital purchase plan, the S&P had its worst week since 1933. In that environment, we wanted to design a program that would rapidly recapitalize the financial system, keep it functioning for the benefit of the entire economy. We wanted to promote lending, or at least reduce the decline that would otherwise occur. And we wanted to facilitate in time additional private capital raising. We also wanted to increase market confidence and protect the taxpayers in any investments that we made. Treasury had earlier considered asset purchases, but we ultimately chose capital injections because they were faster, more powerful, and more efficient with our TARP resources. We sought to design a program that was simple and easy to implement and broadly accepted to maximize the effect. From a policy perspective, our capital program was unique in both its scale and focus. Instead of nationalizing only weak financial institutions, we would welcome all qualifying healthy banks. To do so, we had to address a number of issues. First, even after the passage of TARP, we did not have the authority to force an equity investment into any bank. Therefore, to encourage participation, we had to provide incentives rather than punishment. Further, making the investment program simple and attractive would ensure that it could be implemented quickly, which we thought was very important. Second, we wanted the program to be widely accepted and used by banks. The system as a whole was undercapitalized, and so unless that capital shortfall was addressed, the crisis would simply spread from lesser capitalized institutions to stronger institutions. Third, we wanted to avoid attaching a stigma to the institutions that participated. The week prior, the United Kingdom had announced a program for its banks, made it voluntary. The only banks who participated were the weaker banks, and they had a significant market punishment dealt out to them as a consequence. Stigma, we thought, was a real danger, and so we wanted to avoid that in our program. And to do that, we had to encourage the strong institutions to participate. And we argued that they would benefit from the actions that we were taking, and so it would be unfair for them to sit out. The healthier banks could also justify their participation in part based on the terms that we were offering, because again, our terms were not penalty terms. It was relatively inexpensive capital. It was easy to understand. It was a 5% dividend. It was 3% of risk-weighted assets, and everyone saw the benefits of participating in that. We focused on preferred shares rather than common shares for three reasons. One, there are significant issues we thought attached to the government possibly becoming a significant owner of common shares. Second, the preferred, and on a related basis, secondly, the preferred would be more palatable for the participating institutions to accept on that basis. And finally, from the government's perspective, the preferred shares, since it's placed above the common shares, would offer greater protection to taxpayers. The trade-off was that the preferred shares are less high-quality capital than the common shares. While the preferred shares, we believe, would still be loss-absorbing, they're not as loss-absorbing as common. Nevertheless, it was our view that the preferred shares that we designed were in essence contingently common shares, and that in the future they could be converted from preferred to common, as was the case, as was done later in the cases of AIG and Citigroup. Another critical element of the announcement that we rolled out in early October was the FDIC's debt guarantee program of the TLGP. Both Treasury and the Fed leadership argued strongly that having the guarantee now would help, and taking that risk would help reduce potential future losses significantly. Initially, Chairwoman Sheila Bair was understandably concerned about the potential additional risk that the FDIC would be assuming, but after consultation, agreed with the judgment that that was the right path to follow. The combination of the equity investments and the capital injections were very powerful. The CPP strengthened the bank balance sheets, and the TLGP permitted them to refinance their maturing debt obligations. I'll touch briefly on some assessments and lessons that we've included in our paper. Nellie mentioned that the program was both successful and hated, and that's an observation that we agree with. It was a critical component of the crisis response. It broke the panic, it recapitalized the system, and it laid the foundation for some important steps that Lee will describe in a moment. Profit was not the motive, and it shouldn't be the basis by which the program is judged. But in contrast to projections and predictions that many made at the time, whether it be massive losses, the government, in fact, received proceeds in excess of its investment. While the program stabilized the system, because it helped the banks, that meant by extension it was going to help bankers, and which the public regarded as responsible for the crisis. That violated their fundamental sense of fairness, and that's something that we have to consider in future actions, how to deal with that conflict. Finally, I just want to say I want to acknowledge and thank my co-authors and co-designers on the program, Jeremiah and David Dace and Jeremiah Norton. There was a large group at Treasury who was involved in this, and there's a large group across the regulatory community, including the Fed, the FDIC, the OCC, and elsewhere. The teamwork was a distinguishing characteristic of this program and indeed the broader crisis response, and was a critical element to its success. Lee?
Thanks, Dan. Just on that last point, I want to emphasize that as well. I've said before that the first lesson of dealing with a financial crisis is to make sure you don't have one during a presidential transition. But if you have to, it's important that the people you're succeeding and the people you're working with are as good, smart, thoughtful as these guys were. We couldn't have asked for better partners, both during the transition and subsequently. They really did, as Dan said, lay the foundation for a lot of what we were to do over the subsequent 6 or 12 months, and can't emphasize how important that was. Our objectives as we were, the situation as we were coming in, we were still in the midst of a negative feedback loop between a declining economy, weakening economy, falling asset prices, and fears of insolvency in the banking system, and these things were all self-reinforcing. And our objective, like theirs, was to reestablish confidence in the financial system. We decided that in order to do that, we had to do two things, really. We had to continue to recapitalize the banking system, and we had to ensure that the credit markets were reflective of fundamentals and not just reflective of fire sale prices of assets, because those were heavily contributing to the downward spiral. In order to do those things, we knew we needed a lot of capital. We couldn't know how much at that time. Private estimates of losses throughout the system ranged up to $2 trillion. And although it was preliminary and very early, the Fed had done some analysis indicating that the banking system itself might require capital of around $290 billion in a stress scenario, and I forgot the exact number, I think it was $680 billion in a severe scenario. Of course, we only had at that stage around 250 to 300 $250 to 300 billion left in TARP. So we had to bring more capital to the table. We had to amplify the resources that we had. And sometimes I'll use this capital decision tree. Tim reminds me that we weren't this clear about articulating this back in the day, and I confess that's certainly true. When you need more capital, there's really only two kinds in a crisis. There's government capital and there's private capital. We evaluated, I won't get into them all here, you can all read them in our chapter, different ways we could use government capital and private capital. Ultimately, we determined that it was vitally important that we try and bring private capital to bear on the system as much as possible. There were a lot of reasons, not the least of which was we weren't sure we had enough, and we were terrified that the markets would start to believe that we didn't have enough. And so once you're in that realm, in the private realm, there's really only two ways you can do it. You can get capital to come in voluntarily. You can create an environment in which the world sees the system, markets, banks as investable, or you can coerce it. You can, and of course, you can't force private investors to write you a check. So the only way to get force private capital is through haircuts, haircuts of more senior obligations. Everything we did was focused on trying to bring that private capital back in as a result. Again, we looked at a variety of ways of doing this. Ultimately, we settled on an approach that involved, as I think most here know, there were two main elements. There were the stress tests with a capital backstop. Tim did a very nice job describing the details of the stress tests and how those were developed and how they worked in the chapter. I won't get into them here. But it was a forward-looking test of the largest banks, the 19 largest banks, those who were $100 billion or more. It was forward-looking, and it was designed to show both to the banks themselves, the markets, to us, to the Fed, to everyone else, how much capital those banks would need in a more severe economic scenario, and be in a position where they were strong enough to lend. Importantly, we knew going into this that any kind of credible stress test is going to involve months. It doesn't happen overnight. And we were all concerned that when you announce on February 10th that all the banks are going to go through this stress test and we'll tell you in a few months how it turns out, everyone would run. And what we were trying to do was break that pattern and stop the run. So what we did is we said that each bank at the end of the stress test would be given a period of 6 months during which they could go out and try to raise the capital privately. But if at the end of that period they were unable to do so, that the government stood by, ready to invest what was necessary at a fixed price. So made this announcement on February 10th, set the price at a discount to the prior day's closing price. It was, some have described it as a put on the banking system. It's probably not unfair. It was not, we didn't quite come out and say at that moment, we're going to do whatever it takes. Someone else used that phrase successfully. It essentially was that. It was an effort to try and keep take the most extreme tail off the table, then, I mean, I think everyone knows how it went from there. The stress test results came out, and each of the banks was able to raise the capital privately that the stress test indicated they would need. We didn't end up really having to put the capital in at that stage, and although we were quite prepared to. Just going back to the capital decision tree for a second, all this capital came in privately, but we were prepared to go to the other box, to the government box, if you will, and put in what was necessary. I think I'll leave it there because I see the clock ticking down. There were lots of other programs that were, part of this process. I'm tempted to go into the virtues of the PPIP, but I've been warned. But I'll end it there.
Okay, thank you for both of those. So let me bring the FDIC in, and guarantees and insurance were critical to breaking the panic. Maybe, Jim, could you tell us a little bit? I think it's pretty public knowledge that the FDIC was reluctant to use guarantees, and maybe you could give us some insight as to why.
Here we go. All right, so developing programs on the fly is not fun. And some of the earlier panelists alluded to the difficulty of developing programs very quickly that are going to be successful and satisfy the needs of the objectives associated with the program. Certainly, the FDIC as deposit insurer has insured deposits for many years, but it had not ever systemically guaranteed debt issuances. There were a few specific examples, Continental Illinois, First Republic Bank, where the FDIC had guaranteed debt, but those were case-specific and not systemic and programmatic. So when the FDIC was posed with this question, I think everybody recognized the need for it. I mean, the interbank lending had basically died. There was a severe need that I think everybody recognized. The question was, one, did the FDIC have the authority to actually do it? And so, in other words, this is outside of insuring deposits. So was there basically the basic authority within the FDIC's programs to execute such a program as a debt guarantee program? And the second question was basically there was this exception that would have to be used called the systemic risk exception. And even though the agencies that participate in making that decision had worked out a protocol prior to the crisis on how to come about deciding on whether to invoke the systemic risk exception, this would have been basically a novel use of that interpretation because everybody had been thinking in terms of institution-specific invocation. And in fact, prior to the debt guarantee program, it was used for a single bank resolution or prospective bank resolution, but it had not been used for a systemic type program. So there was the question of authority, whether or not there was the ability to, within the FDIC's authority to do this. There's a question of using the systemic risk exception. And then, of course, there was just the mechanics. There was just developing the program on the fly, whether or not, given the FDIC's background associated with deposit insurance, whether or not it basically was going to hit the right buttons associated with the guarantee program. And quite frankly, we didn't. I mean, there are a few areas where we kind of missed it. I mean, one, as an example, was what constituted a default and when payment would be made. The FDIC, of course, typically looks at when a bank fails is the point in which the deposit insurance guarantee kicks in. There's a claims process, and then depositors are paid very promptly, and maybe have an opportunity to talk about the closed bank part of this panel a little bit later. But the debt guarantee program and investors were looking for very, very prompt payment. Otherwise, the ratings that were going to be necessary in order to provide the liquidity outcomes that were desired from the debt guarantee program wouldn't come to fruition. And so there was that type of tweaking that had to be done. Eventually, through a number of program modifications, they did occur, and the program was substantially enhanced, and I think ultimately was very successful. Over $300 billion at its high point was guaranteed through the program, but it didn't come without some trepidation and angst over both the authority and then also just the mechanics of getting the program up and running.
Stress tests also developed on the fly, another program. Maybe Tim, if you could give us a little insight why this was so radical and why we didn't actually know what the losses were at banks during the crisis.
Sure, yeah. Well, thanks, Nellie. And thanks for having me here. I did notice, actually, that other than my former boss, Pat Parkinson, I'm the only supervisor on the panel, and Pat was only a supervisor for a very short period of time. So it's really great to be here, and I do want to acknowledge the hundreds of people that worked on these efforts from the supervisory side as well as all sides of all the agencies. So let me start with the obvious sort of radical aspect of the stress test, and I'll try to be careful here because my favorite lawyers are both in the room. One way at the back, but the requiring firms to raise more capital when they were reporting capital levels that already met the requirements was a bit of a challenge. It hadn't really been done before in this way. And so the way I would phrase this, and I hope that I won't get in trouble this way, we basically redefined a supervisory expectation for what capital firms needed to hold to be safe and sound. Some would say we created a regulatory standard. I would say we didn't. That was something that was pretty radical at the time, because basically up until that point, all we had said is, in the terrific, articulate way that we could over the years, was banks had to hold enough capital to basically be commensurate with their risk profile. As we all knew at that point in time, the banks had no idea what their risk profiles were. And none of us knew what the right amount of capital was, right? So that was, I think, the most obvious, real kind of radical change, if you want to call it radical. A couple other points that come to mind on that is, we had just spent the last 10 years working with supervisors and regulators around the world to develop Basel II standards, including Basel II's, favorite stepchild, the internal models-based approach, and basically, what that was a carryover from what I would call sort of a deregulatory fervor that was prevalent at the time with GLBA and other things that basically said, the banks know best, and the banks can model this stuff correctly, and the banks are going to develop through all sorts of really great financial engineering, good prospects, and they're going to tell us how much capital they need. That actually had been what we'd been doing for a long time, was moving towards in that direction. And so what we basically did here is kind of turn that all on its head, throw that all out the window, and in fact, we told the banks how they should be thinking about their capital, and we explained to them actually what we at the time believed was a better way to consider losses. And then that which leads to my last point probably is the use of scenario analysis. Whole bank scenario analysis, which really in a sense is modeling the capital needs of a bank through all aspects of where that capital may come from and where the needs may come from, I think was a strong innovation, something we hadn't used before. We did make it. It's the wrong way to put it. We didn't make it up. We developed it on the fly through some tremendous work by a lot of people, as I said before. And so those to me are sort of some of the major aspects of why it was so radical. And I want to just say one more word on the other. We have to remember that prior to the crisis, we had a long-standing period of supervision where we really believed strongly that market discipline and banks' interest in self-preservation was going to lead to, safety in the system. And so for supervisors, myself obviously being one of them, I came in 1995, so sort of grew up in that era. This was a real radical change where we were basically saying, oh, wow, market discipline didn't work, bank self-interest didn't work. Now we've got to help the markets and the banks figure out what's going on. That was a really big deal.
Thank you. Some of the criticisms, and I'm going back to Dan and Lee, some of the criticisms of the equity injections relate to that we sort of gave a gift to the debt holders, that somehow we didn't do debt for equity swaps. And just, it sounds like, Lee, I know you all often talk about open bank resolution, and there's some element of some kind of swapping going on. I just wondered if you two could speak to that issue and what our authorities were and how we could address that.
Want to begin?
Say a couple things. So one, again, if you go back to what Dan and I were describing as the dynamic we were trying to break, there were runs throughout the system, and it was very important. We thought it was very important. I'm sure these guys did as well, to not pour gasoline on those flames. And we felt quite strongly that if we were to haircut senior debt, and I'll come back to the more junior parts of the capital structure, that if we were to haircut senior debt at a particular institution or institutions, no one would really believe us if we said, yeah, we're going to stop with those two. I think the creditors of other institutions would likely be fearful and start running from them as well. Now, there are virtues in being able to use other parts of the capital structure. So if you go back to what we were discussing earlier, when we said we stand by ready to invest whatever we had to in the banks at the end of the 6-month period after the stress test, we also knew that we didn't have much capital left. We had 100 or 150 that wasn't already committed. There was a fairly thick, though not thick enough, layer of subordinated debt and preferred stock at these institutions. And Nellie mentioned open bank resolution. There's a piece in the chapter where we describe what happened with Citigroup. I won't get into the details there, but and Dan referenced this in his remarks as well. In the middle of the stress test, Citigroup approached us and I think recognized that they needed to have more capital and higher quality capital. And our predecessors had done a terrific job, put in the preferred stock. I think Dan called it. I wrote a note. Contingent common. And it did turn out that way. Citigroup ended up swapping, the original bunch of the original TARP preferred, and converted it to common, simultaneous with converting their other preferred stockholders. And turning that into common as well. So, we were not going to haircut senior debt if it could at all be avoided. We did use other parts of the capital structure, and haircut's the wrong word in that context. It was converting debt to equity. And it was all because we didn't want to accelerate what we view it as a run on the system.
Next question first. Anyone on the panel, what was one thing you thought about doing and then didn't do it, and why? So I'm just trying to dig into the whys about why this turned out to be so successful.
One idea that we had, well, a couple ideas. I made reference to initially the thinking at Treasury had been to purchase assets rather than inject capital. And as I described, we ultimately rejected that because we thought the capital injections would be faster and more efficient and more powerful. The asset purchase idea, as it was researched further, the best scenario would have been we would have been running test auctions sometime in December for a few $100 million. And then if those went well, the idea would be about $5 or $10 billion a month thereafter for several months. And that's a very long timeline given the circumstances that we were facing in early October. I'd say the second idea we thought about with respect to the capital purchase plan was whether there should be an element of market discipline introduced by requiring participating companies to go raise qualifying capital, go raise common equity, and then the government would match with preferred or something else. And that was an entertaining discussion for a brief period of time. Conceptually, seems like a nice idea, but practically speaking, the market was closed even to the strongest, most well-capitalized institutions, so we dismissed it as unworkable.
I guess I'll jump in with one, and speaking for myself only, I guess, but one of the things that I think everyone was thinking about, I say after saying I'm speaking for myself only, is the resolution mechanisms, right? Ways in which you could split apart large, complicated institutions and possibly hive off a bit here and a bit there. And due to the lack of, planning and attention given to that prior to the crisis, we found our situation where, in fact, I think some of us were quite startled to discover the extent of some of the connections within the organizations that didn't seem to necessarily exist for economic purpose, but for a variety of purposes that would make it almost impossible to pull them apart in a rapid manner. And I think that is something that we had to dismiss rapidly because it just wasn't possible. Hopefully, it will become more possible as time goes on. But.
I guess I would just say we considered lots of the same things that our predecessors considered and ended up not doing them for the same reasons they decided not to do them. Lots of them sound really good. When you first talk about them, they all sound much better, much more palatable than what we did. They would have been much more politically palatable, I guess. But when you dig into the details of what each would entail and what the downsides to them are, we reached the same conclusions as they did.
I would just, talking about PPIP earlier, say that, I don't think it's necessarily an either or. I don't think it's either, basically a capital injection or asset purchase type programs. But the question is, should one have complemented the other? And should parameters have been set up for utilization of one versus the other differently? And so I think this is something to look at in the future, because certainly many other jurisdictions look at asset purchase type programs, bad bank type programs. RTC in many respects was a big bad bank here in the U.S. The model is tested and proven in application elsewhere. And so the question is, I think, admittedly, a lot of this was thought of on the fly, and that's the reason why I think this type of program is extremely beneficial, because it lays the groundwork for hopefully continued thinking on these matters so that when the next crisis hit, you don't have to sort of like say, it's going to be one program or the other, but you can basically have a more nuanced approach.
I agree with that, and I would say the best time to plan for a crisis is before it commences, because once it commences, your options narrow based on market factors and political considerations and other matters. And so I agree, it's not necessarily an either or. There's tools to be developed and considered, and they ought to be done well in advance of the next crisis.
So I have some questions from the audience. This first one is not in the form of a question. It says, call on Hank. So I'll call on Hank.
So, thanks. I have one observation, then I do have a serious question. But the observation was this. I know Dan alluded to it, but I just want to mention context. After Congress passed the TARP, that week was a nightmare. There was, rather than the markets calming, that there was panic around the world. 7 European nations need to step in and prop up their banks. We needed, so when Jim made the comment about moving on the fly, I was just thinking how grateful I was because we announced programs knowing they weren't perfect, and then you all worked around the clock to fix them, tinker with them, and make them work. But my question is this, and maybe it's more for Tim than the others as an examiner, which is one of the things that struck me when I arrived in Washington was the extent to which regulators felt financial institutions, banks, were adequately capitalized or more than adequately capitalized when people coming from Wall Street, although their behavior might indicate that they thought they were, knew that they weren't, okay? That when you look at the leverage that was embedded in terms of derivatives and all sorts of contracts and so on, and what was it? Was it just maybe not using scenario analysis? Was it an outdated way of looking at it? Was it regulatory capture? Really, how do you look at it, and how as you think back on that?
Yeah, that's a great question, and I'm really glad that you asked it. So I would say that my time as a supervisor, for the most part, leading up to the crisis, there was a very strong view that if the banks thought they were adequately capitalized, they were adequately capitalized. Right? The banks should know best. They had a self-interest in holding the capital that would make them safe. That was very much behind the whole supervisory framework that we had. Now, we didn't leave it at that. We had some minimum requirements, of course. But there was a strong belief that we should not push too hard against these people who were clearly somewhat smarter than us. I'm just being blunt, right? That's really what it was to some extent, right? So the idea that the bankers thought that they weren't adequately capitalized puts me in a very strange position because it's their job to ensure that their firm is adequately capitalized, right? So it's it's an interesting question, and that may be too simple of an answer, but maybe we fell prey to the bad math of financial engineering, where people would come and say, look, there's no loss in this exposure I have to a financial guarantor. And we're like, yeah, you're right. How could you lose? It's AAA, it's AAA, right? When the banks, to your point, knew very well that actually what they were doing was managing P&L. They weren't buying insurance. They knew there was no insurance. They knew those people could not pay them if they actually ever had to in a really serious downturn. They were managing their P&L volatility associated with the derivatives. So anyway, it's a great question. That's maybe not the perfect answer, but I think you have to get into the mindset that it was expected and taken as a given, I think, across many supervisory agencies, that if the banks knew best and they knew what they needed, right? And their shareholders in the markets would discipline them if they stepped outside of that. And I think we became way too comfortable with that. And so I'm really happy to see the changes that have come since the crisis, where we've actually said, look, maybe you don't. And I guess as we all learned, they didn't. So anyway, it's a great question. We could probably talk about it for a long, long time. But,
Okay, I have a couple questions that relate to sort of the public capital versus private capital situation. So one is, how did you think about the role of private capital in designing the public capital? And then this kind of dilemma of, if you want them to take private capital, why are you making public attractive? So just trying to address that kind of what seems on the surface a dilemma.
Speaking for the program that we initiated, we wanted private capital return, and we thought an effective way to accomplish that would be having this preferred, which would be less dilutive than had we made a common investment. We also had incentives in the preferred for repayment. It had to be repaid by qualifying capital, so that was further encouragement for someone to exit the program. Having accepted it, they had to go raise qualifying Tier 1 capital and high-quality capital to replace the preferred. So that was an incentive for them to go raise high-quality capital. We also had a feature in the warrants that were introduced where they could reduce the amount of warrants outstanding if they completed a issuance of qualifying capital by the end of 2009, which a number of institutions did so. And so those were, in our thinking, those were the steps that we took to encourage further private capital raising.
So I'm not sure what to add to what I already said. I mean, these guys had put in the public capital, the government capital early on. It was crucial, it was vital, and I think I included the words on this slide: private beats public if time allows, and those are important words. The fastest way for them to get capital into the system, I don't want to speak for you guys, but when they were doing it, was to do what they did. We had, I don't want to say we had the luxury, but we had some time to develop a program that would allow us to pursue a private capital approach. We thought it was more desirable for the reasons that I mentioned earlier. But B, again, we didn't know if we had enough of our own, and had no choice but to bring private capital to bear.
I mean, a significant component of the private capital raising was the retained earnings that the banks began to earn in 2009. Right, their earnings recovery helped quite a bit.
Yeah, they had some of the banks had earnings in the first quarter that helped. I mean, I think where earnings really came in was, and Tim may have touched on this earlier. The stress tests were a forward-looking, was 2-year forward-looking exercise, and one of the components was the pre-provision net revenues. So it was the 2-year forward earnings that the banks would have as part of the stress test analysis, and that was key. I mean, one of the dynamics. I don't want to go down a rabbit hole here, but one of the dynamics that was going on in the early period was there was a tension or a tug of war between those who thought we should mark banks to market and those who said that's, we don't want to change the rules of the game, midstream. But there was a large contingent in the marketplace that was looking at asset prices and saying if banks had to mark those to market, their earnings would be much worse. Banks look a lot worse when their assets are at 40 cents on the dollar than when they're at 80 or 90 cents on the dollar. And the way that these forward-looking pre-provision revenues were treated in the stress tests, I think appropriately, took into account the fact that there would be these positive revenues, both in the first quarter, as you were mentioning, Dan, but also going forward. And I think that was important, and I think the markets weren't actually focused on that before that period. So.
Yeah, well, maybe I just could add a little bit to that, if I could. The whole mark-to-market question that was going on at the time, what they were really talking about is marking to market the assets of the banks. Mm-hmm. What the stress test really attempt to do, and just to be clear, most of those assets are actually only marked to model. They're not marked to, there is no market for a lot of those assets. What the stress test really attempted to do was mark to model the entire bank, including its earnings, and then with the outcome of that model being how much capital do they actually have. So I don't know if it's quite as distinct as we make it, but I mean the idea of just marking to market the assets of a bank and ignoring all other aspects of it, I think is problematic, and I'm glad that we didn't go that route. But yeah.
So I have a few questions that are somewhat trying to second guess a little bit, but I'll let you guys try to tackle some of these. So was it a mistake to allow the banks to pay dividends during this period?
Yes.
Did you have authority to do otherwise?
I think we always have authority if we're concerned that it's a safety and soundness issue at the bank to require them to stop paying dividends or to even to raise capital. We did not take advantage of that authority, and I think in hindsight, certainly my own perspective, I don't work at the Fed anymore, so I don't have to say this is not the view of the board. It was a huge mistake. A tremendous amount of capital were paid out to their investors that then had to be made up either through further capital raises or government capital injections.
So that was more clear than I thought.
Although Nellie, I want to actually bring up a little bit of an analogy to this with the deposit insurance fund, because one of the tensions that was presented to the FDIC board during the crisis was basically how to ensure that the deposit insurance fund had, one, basically the capital basically to ensure confidence among depositors that the FDIC would be willing to and capable of honoring its deposit insurance obligations, even though it was fully backed by the full faith and credit of the U.S. government. You know, depositors, there was just a constant drumbeat in the media about the health and wherewithal and vitality of the deposit insurance fund. And the concern was that basically if the FDIC fund balance became negative, that there would be a time lag, or in which it would be able to honor its deposit insurance obligation. Second element is liquidity, is that does basically even regardless of what the fund balance is there sufficient liquidity for the FDIC actually to meet its obligations? And so at the time of when you're in a crisis and capital is difficult to get or costly, is not the time in which you are to be bolstering your capital levels. And with the FDIC, it was restricted prior to the crisis in its ability to take the deposit insurance fund beyond 1.25%. Basically, there was a minor legislative change just beforehand, but it was too little, too late. So in essence, you know, it was capped and didn't assess insurance premiums except in some rather exceptional circumstances for basically 3 years prior to the crisis. And then when the crisis hit, it was faced with having to make a special assessment, and then, which is something it didn't want to do, and then basically it did have to basically ask the banking industry to prepay its deposit insurance premiums, which was, once again, a rather novel approach. But this is really analogous to what Tim was talking about with respect to dividending at banks, is that there is, in good times, there's the pressure to not bolster your capital levels, and then when bad times hit and you need the capital, it's very difficult, and you're faced with some very tough decisions at that point in time.
I would have great respect for Tim and his observations, but I think I may disagree with the conclusion about dividends, because it goes back to the premise upon which we were rolling out the CPP program, and our desire was,
Can I say common dividends?
yeah, common dividends, yeah.
Okay.
So there can be debate on this, but this will make it more interesting than if we all agree. If you accept as a premise as sound that we wanted to encourage broad participation and we wanted everyone to participate, including the strongest institutions, I think imposing a condition that they had to cease payments on their common dividends would have frustrated that objective. And as a consequence, I think people would have not participated in the program. Then the program would have been converted, instead of a broad-scale recapitalization, it would have been converted into triage for the most distressed institutions. And that's the path we didn't want to go down. I'll ask Ben or Tim or Hank to comment on it.
Reasonable argument.
Yeah.
That's different though than the stress test. Because the stress test there, you were imposing, your will on the banks. So again, that's maybe a different question.
Nelly, can I ask a question? How do you guys answer the following puzzle? So the regulatory system for capital was badly designed and inadequate in the moment, as Tim said, and only applied to 40% of the financial system. It was not designed for the extreme shock, not adequate to that. People were very worried about solvency in the system in the fall of 2008 and certainly early 2009. As Lee said, loss estimates people were bandying about in early 2009, even early 2009, were like, north of $1 trillion. Yet in the end, the incremental capital needs identified in the stress test were tiny relative to those expectations, did not require any further injections of public capital, except for GSEs and some contingent AIG stuff. So how do you square the circle and explain why, if the system was perceived to be insolvent, was it resolved and the solvency concerns dissipate so quickly and so effectively on the strength of a disclosure exercise that resulted in modest incremental capital requirements? This is not to diminish the coolness of the stress test and its effect.
I'm tempted to say PPIP. Not sure where to go from there. No, look, I do think there is something to, like, a lot of those loss estimates were looking at, prices of assets in the market. And again, if you say these things are trading at 40 cents on the dollar and these banks have a lot of stuff that looks just like that, therefore I'm going to, look at that institution through that lens, it can look in the moment as if they're insolvent. And loss estimates were based on those market prices. I do think, going back to the way the stress test was designed, it didn't look at those market prices. It said, and Tim will correct me if I get this wrong, but what are the losses that this institution can expect over the next 2 years due to non-payment on those loans or assets? Not, gosh, it's trading at 40 cents on the dollar. And by the time, as the next period unfolded, those assets had come back. So that's one. I don't want to say that's the whole thing, but I do think it's part of it.
Go ahead, and I'll add something.
All right, so this reminds me of a question that one of the FDIC board members who was a supervisor would ask every time one of the institutions that was supervised by the agency failed, and we'd come up with loss estimates that were, in the millions of dollars and these are small community banks, and yet the prompt corrective action regime requires basically the institution to be closed roughly at 2% capital, roughly, give or take. And so why was it constantly, time after time, the FDIC would be incurring losses if, in fact, the institution was supposed to be being closed at 2%, roughly 2% capital? And of course, the reason is because the expectations are different. In one case, it's a going concern. You're looking at the intrinsic loss associated with the asset. And if the institution is a going concern, it doesn't have to take the additional discounts the market imposes on the assets for liquidity and risk. That basically is already there at the institution, and what the institution is essentially doing is just looking at the life of loan, life of credit loss associated with that. And it is a bit of a flip of a switch, that a going concern value is going to have a different outcome and a different perception compared to gone concern. So you could have analysts looking at these institutions during the crisis saying if they failed, or this is what basically the insolvency is associated with them, that would be one number. But on the other hand, if in fact they remain as going concerns, it is a different number altogether. And I mean, this is seen time and again with failures that the FDIC actually handles in closed bank scenario, and under our prompt corrective action regime, where institutions are purportedly closed with a de minimis level of capital, but in fact they end up costing the deposit insurance fund money.
I would add a couple of comments, maybe offer an idea for consideration. One is I think part of the analysis was not simply numbers on a piece of paper, but the fear that surrounded the numbers. And this will now take us to our theme of how vital and important it is to have very clear declarative communications about what our objectives are when we take actions. We made a number of fits and starts along the way. And that was, I think, reflected the capacities that we had at the time. And as we developed a full range of capacities, including the TARP authority, then we were able to be more resolute on our desire and intent not to let systemically financial institutions fail. Even having said that, though, I don't think it became clear until, as Lee said, let's not have a presidential transition in the middle of the next crisis. I don't think it became clear until sort of the first quarter of 2009 that sort of nationalization was off the table. And I think that was a significant fear, which was, and once resolved, that in addition to the data provided by the stress test, I think lessened the fear and increased the confidence.
So I would just add, which is a little bit along what Jim was talking about, that I don't think it was a foregone conclusion that the losses couldn't have gotten that bad. I mean, part of the effort in this program was actually to try to create some certainty in the markets to restore some confidence so the firms could continue to operate. Relates to back to that point. It may well have been a failure, and the losses could have been tremendously larger than they turned out to be, which I think is sort of where Jim at, but I'm thinking on the system. So.
Nellie, I would just add, I just want to emphasize what Dan said from our perspective. I think that the fear of quote nationalization and all that would entail with respect to potential creditor haircuts, dumping of assets onto the market was a quite significant factor. I couldn't agree more with that.
Okay, I have a couple, I'm going to follow up with two kinds of questions. The first is sort of moral hazard and fairness and justice, and justness of the programs, and this responds to a few of the questions here. I think we've convinced people that, yes, it was very important to save the banks, and why did you save the bankers is a question. And, how was fairness or moral hazard considered in developing some of the programs? So that's it. And then that's the first question.
Dan?
So clearly moral hazard is a risk and was a factor in our minds as we contemplated the actions that we undertook. I would say we weighed that risk against the risk of a cataclysm in the system of default and the systemic breakdown. And in judging those two risks, we thought it more important to avoid the systemic breakdown than establish a point that we were not going to encourage moral hazard.
I'm going to just take your question and reframe it slightly, and that is, I think one of the takeaways that from the crisis is that it becomes very difficult to balance long-term moral hazard, accountability, market discipline objectives, which are embedded in many of the policies in the regulatory sphere, with short-term needs. And it's extremely difficult in the moment of crisis to start, weighing the pros and cons on this because you have to ultimately balance the two. And to the extent that some planning and advanced thinking can position policymakers to avoid being forced into that position would be helpful. I'm not sure you can ever get there 100%, but to minimize that so that you aren't faced with then the outcomes that here, for example, the capital purchase program is immensely still to this day unpopular because of the moral hazard issue and the banker fairness issue, yet it clearly, on an economic basis, was very successful. So it is one of those I'll call it dilemmas that once again, if there's maybe some additional planning, maybe policymakers in the future don't have to be quite in as difficult position as they were in 2008.
I'll just go back and say, I think I said it in my introductory remarks, we failed to identify an avenue to aid banks without aiding bankers. And that's a feature of the program, and a regrettable one.
Okay, last question for anyone or all of you. So when you're in a panic, you're always working with very limited information. You're working in real time. There's lots of uncertainty. Anything you know now that you wish you had known then? And, is there something
I wish
that
Hank didn't know my
could
phone
be
number.
done? That we could fix so that this doesn't happen next time.
So I'll take a quick stab at that. I mean, someone said it earlier, right? The best time to prepare for a crisis is before the crisis happens, right? And I guess I could say I wish we had known before we got into that crisis that we were going to find ourselves in a situation where the banks, the regulators, the supervisors, nobody had the information that they needed to actually understand what was going on with the losses in the system. That's unacceptable, right? And so that's something that not only can policymakers change, they have changed that to a great extent. Obviously, you can never have all the information you need, but just more preparation, more work on resolution and recovery in advance, like get those things sorted out, make sure you have the data and the understanding, make sure that the regulators have the authority to quickly take action to restrict capital outflows from firms, et cetera, et cetera. And many of those things have actually been done since the crisis. There's obviously a lot more work to do, but that would be my answer. Yeah.
I'm going to sort of just take a little bit of a turn here in that we've been looking at capital just as like preferred and common shares, sort of like your core equity. But the reality is that in looking at how to deal with the resolution of a systemically important institution, there's contingent capital that could, or bail-inable capital. And so, I think one of the takeaways from the crisis is that maybe we should have beforehand been looking at what type of capital could be bailed in and setting market expectations for that ex ante. Because now, whether or not that's just convertible debt or something else, it kind of remains to be seen. But the reality is that there's a little bit of setting of the table that needs to take place. But if market expectations are such that the capital is available, but it's not necessarily equity, but it's available in the capital stack, I think it sort of serves a lot of the purpose that we attempt to strive to achieve.
Now, Nellie, just before we do,
Beep, beep.
Well, yeah, another time. Just in my eagerness to make sure to compliment our predecessors and our colleagues at the Fed and others, I did neglect just a couple of groups, and I see some of the folks from the New York Fed who are out there who, during the early parts of the transition in particular, were invaluable. We knew a lot more and were a lot better off by virtue of their efforts than it would have been a worse disaster by far if it weren't for them. And second, of course, my partner, Matt K. Baker, who is also a co-author on this paper and did a tremendous job as well.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.